Hey there YouTube, welcome back to the channel, and today we're going to be talking about everything that you need to know when you're investing into real estate. But first, I'd like to change things up a little bit. As you know, a lot of things have been going on that have really hindered our economy right now, and a lot of businesses are really struggling because of this. That's why I want to find a way to give back in any way that I possibly can, even if it's just small. So for this video, if we get over 100 views by next Friday, I will be choosing one person that has liked and commented on this video and has subscribed to the channel to win a $25 gift card to Fandango. This will really help support the movie theaters because right now they're having to push back a ton of release dates like The Black Widow and other movies. This has really made it a struggle for them to stay above waters and stay in business. So let's make sure that we get this out to as many people as we can, friends and family, and get over 100 views and get that gift card out there. But without further ado, let's jump into everything that you need to know about real estate before you start investing. So first, I want to talk about the requirements for a home loan. So you may or may not know that there's two different ways that you can purchase a house, and that's either outright and in cash, or you can get a loan from a bank that gives you the money to go and purchase a property that you can then live in or invest in. Just for both purposes, I'm going to tell you exactly what you would need to qualify for both a residential loan and an investment loan. For a residential loan, you usually need on average at least a 680 credit score. It can be lower, but just remember that if it goes lower, your chances of approval go down, as well as the amount of your down payment increases as your credit score decreases from that 680 credit score. But the incredible thing is that usually a residential loan only requires a down payment of 3%. And just for reference, these are all the numbers for if you're looking to get an FHA loan. Now for an investment property, things are a little bit different. So a down payment usually ranges from anything like 20 to 25% of what the home costs, and you usually need about a 720 credit score to qualify for that loan. It can be less, but once again, if it goes below that 720 credit score, your chances for approval drop and the amount of your down payment usually starts to increase. Now here's something really important that we need to make sure is crystal clear for all of you out there listening. There is a difference between what kind of loan you can get. You can either get a 15-year loan or you can get a 30-year loan. Now, usually people would think, all right, let's do the 15-year loan so I don't have to pay off this house for as long and I won't end up having to pay as much interest in this home. But that's not true at all. Here's why I recommend doing a 30-year loan. The reason that is because when you do a 30-year loan, your interest rates drop because you're making more payments than what you would over the 15 years that you own the home. And because you do a 30-year loan, the difference between what a tenant is paying and your mortgage increases, and that means that your passive income every month is more than what it would be with a 15-year loan. Now, this is a topic that I'm going to cover even further in the next videos for next week, and this is because I'm going to be talking to you about the two best ways that I found to invest into real estate. Now, there's one more thing that we have to touch on just briefly, and that is when you go to get a loan from a bank, they're going to look at something that is referred to as your debt to income ratio. Now what this means exactly is they're going to look at all of your expenses monthly. So any memberships you have to climbing gyms or other things like that, or even your house payments if you're making mortgage payments, they're going to take that number and see what kind of percentage it is of what your income is monthly. And if that percentage is over 43%, they will more than likely not qualify you for the loan. And the reason this is because they want to make sure that you have the financial means that if anything ever happened, you would still be able to pay off your home and that there's probably still some savings somewhere if your expenses were only 43% of what your actual income is. And on top of that, with an FHA loan, your housing ratio can't be above 31% either. And it's really important to keep in mind that every bank is different and they set their standards a little differently. So if you don't think that you can qualify for a bank, make sure you're calling multiple banks because one of them may even accept you even after all these numbers that I've given you on what an average person usually has when they qualify for a loan. And if this task seems daunting and too hard and it's just not making sense, either go and read up on it some more so you know exactly what you're looking for in a loan, or you can even look into getting a mortgage broker. And a mortgage broker will kind of help you figure out which path to take and what banks might be the best in helping you finance your home and getting that approval for your home loan. But talking about paying down mortgages and down payments and everything, this leads us into our next portion of the video, which is equity. Now, equity might have been something you've heard already, but when I started my journey almost a year ago, I really had no idea what this was. So I'm going to explain to you exactly what this means. Equity can be found in a home whenever you purchase a house under market value or every time that you make payments monthly on the home that you own. And in fact, you're creating equity when you put in that initial down payment to get the loan from the bank. Now, what equity is that it's the difference from what the market value of your home is and how much you exactly own on that home. So let's say a home is worth $415,000 and I bought the home for $400,000. That means that I would have automatically secured $15,000 of equity in this home. And when you make your down payment and your monthly payments, that just increases the difference from what you owe on the home to what the market value of the home is. And in between those two figures is what your equity on the home is. Now, why is this important to know, you might be asking? And that is because you can use equity in a very strategic way. If you use equity correctly, it can lead to multiple other homes without you ever having to put any money into it. And I'm going to touch briefly on how you'll do that right now. But once again, in the next video, I'm going to go into more depth on how it's done. When you have this equity in the home, you can get what is called a HELOC, and that stands for Home Equity Line of Credit. So what this HELOC allows you to do is borrow 75 to 90% of whatever equity you have in your home. Now, this is why it's so important. So going back to our earlier example where I bought a home for $400,000 and the home's market value was actually worth $415,000, I just made $15,000 just by obtaining an asset. So now let's say I wanted to take that $15,000 or 90% of that $15,000 and I wanted to go and purchase another home for whatever reason that may be, whether it's investing in another home or making a down payment for my residential home. The average interest rate of a HELOC is usually from 5 to 6%. And that means that you're going to be paying that bank back that $15,000, and each payment you're going to be paying 5 to 6% interest on top of those payments, which isn't horrible, but there's another way to get that down. And that leads us into the next part, which is how to take money out of an asset where money may be locked up. What I'm referring to is called a cash out refinance. And so what this basically means and where we're going to be using it is once you've paid down a home so much and you have that equity, but you still have a portion where you still owe money to the bank, you can go and get a cash out refinance from another bank. And what this does is that it gives you cash for the value of your home, so you can pay off the remaining debt you have from the last bank, and then you can keep whatever equity was left in that home. But just to be clear, don't think I'm telling you to go and buy your favorite sports car with that equity. The thing is that you want to make sure that you're only purchasing good debts and you're never obtaining bad debts. Bad debts are what get you into trouble. They're things that you're held liable for and that just rack up costs and never appreciate in value or bring you any money in. A good debt, for example, would be a home that brings you in monthly income and that also appreciates in value. So if you're trying to pay back that HELOC that we were just previously talking about, you could take that portion of whatever the cash out refinance was and just pay that loan off so your interest rates are lower than that 5 to 6%. Now, this isn't the only way you can use the cash out refinance. You can also use it to just take it and go invest into more properties and roll it over into helping you earn even more passive income. But let's say that you're ready to get rid of a home and you just don't want it anymore. Maybe it's getting a little old. You don't want to have to do the refurnishing of it. You don't want to have to do any of the remodeling for the home. Well, there's a different way that you can do that as well, and that's referred to as a 1031 exchange. Now, what's so great about a 1031 exchange is that you're not taxed on it when you sell the home. But there are some rules that you have to follow to ensure that that happens. And I'd just like to say before we go any further, I'm not a financial accountant or anything like that, so I'm not legally giving you advice, but if I was going to do this, these are some of the strategies that I have learned that are possible through different methods. So let's say that you sell this house and you want to do a 1031 exchange. What that basically means is that you take whatever money you earn from this home, and as long as it goes back into the market and is rolled up into more homes, you don't pay any taxes on that. Now, this is a super useful tool when creating passive income because you aren't getting stopped in your tracks by having to pay taxes on certain things that could cost you thousands of dollars. But these two things together are going to be very important when we start talking about the different strategies to invest into real estate in our next week's videos. So I wanted to make sure you had as much knowledge about these things now before you start investing into real estate, because I'm going to be honest with you, there isn't just one way to invest into real estate. You can do it a variety of different ways, and really it comes down to opinion on which way you think is best. But these are and will be the biggest concepts to know as you move forward in investing. And make sure you come back next week because I'm going to be revealing to you the number one way that my mentor does his real estate investing, and then another way of investing that I find extreme value in. And both of these are going to blow your mind in how much return they can possibly get. I post videos every Monday, Wednesday, and Friday at 12 p.m. MST, so make sure to be here every time on time to get the next update on everything that we're learning. And don't forget, make sure to like this video, comment on it, subscribe to the channel, and share this with all your friends. If we get over 100 viewers, we're going to be giving away a $25 gift card from Fandango in hopes to help the movie theater industry.